A false breakout, also known as a fakeout, is among one of the key technical reversal patterns some traders use to look for trades against the prevailing trend. A false break happens when price momentarily moves above a previous high or below a previous low, but then immediately goes back within the existing range. The brief breakout which has failed implies there is not enough demand above the old high or enough supply beneath the prior low to help push price significantly in the direction of the break. So when a breakout fails, it clearly indicates that the prior trend is basically exhausted, and this encourages people to exit their trades that were previously making them profit. At the same time, traders who were anticipating a reversal but were waiting for the right moment to step in would now be doing so. So what you will often see is an accelerated move in the opposite direction, which could provide significant reward if traded correctly. Now, false breaks can happen on any time frame. Generally speaking, the higher the time frame, the better the quality of the setup tends to be. Regardless of the time frame it happens, one of the key price characteristics that we look for when anticipating a potential false break reversal is a fast move in the final leg of the rally or sell-off into an old significant high or an old significant low. However, if price simply drifts towards the level, typically it will break through it. After all, the more distance price must travel to an old swing point in one period of time, like a day or intraday, the more likely it will be hit by profit taking, which thereby increases the likelihood of a rejection. Now, being able to identify such setups may not only lead to better trading opportunities, but could potentially help you cut your losing trades quicker if you happen to be one of those breakout traders that has been trapped. These trades normally have favorable risk to reward profiles, allowing the trader to put on sides behind the trade as the stop loss is typically very tight, especially if the fake out is identified on the lower time frame relative to, for example, an entry based on the daily or weekly time frame. Let's now discuss how a typical false breakout scenario may look like. Well, let's assume the market has been trending higher, but it hits resistance here, causing prices to dip, but the bullish trend is still intact and prices recover as investors buy the dip, as they have been doing so in this bull trend. However, price then consolidates ahead of resistance for a while as existing bulls take profit, while some bearish speculators start piling in on the short side and placing their stop loss orders above the most recent highs. But then price comes back one more time and bursts through the resistance in one clean sharp move and stops out the sellers before reaching an exhaustion point. Price then quickly returns back to the point of origin of the breakout. So here the expectation would be that the trend would continue higher. People who were previously selling would be looking to close out their short positions because it hasn't worked out for them, and new buyers would be expected to step in to buy this latest dip. So there'll be lots of buying action happening around this former resistance level, or at least that's what the market would be expecting, and those expectations alone can be the reason for some to step in on the long side here. Lo and behold, price starts trending higher, and so far it looks good, but then reverses sharply to break the support as demand to buy this market at this technically important level turns out to be weaker than expected. But price then typically retraces as people who are used to buying the dip continue to do so, causing price to rise back to the old or towards the old resistance level. This time though, the buying pressure is lower than the previous occasions and it turns lower, again trapping the buyers. As further support levels break, the momentum changes slowly but surely in the favor of the sellers. So these are some of the areas you could potentially look for bearish setups. For example, here, which was previously support, or a level like this, if price gets to this level, which was also a previous support prior to the breakdown. The whole point is basically that the trend has now changed to bearish from previously being bullish. And so rallies will get sold into after price created this fake out here. Now here's an example of how a false breakout scenario may look like in a real life situation. As I mentioned earlier, the false break happens on all time frames. Here we're looking at the weekly time frame of Brent crude oil. In fact, if we look at the monthly chart, this underscores the importance of the higher time frame. Here, for example, is a perfect example of a swing failure. We had a high right here. After several months, price tried to break through that high, but failed, creating this inverted doji candle. And following the formation of that candle, look how price went down and stayed down. In fact, crude oil has never got back to this level. So you can see the importance of the higher time frame setups. I can show you further examples. Let's go back to the weekly. In this case, there's no gap and price has risen really sharply for several weeks to get to that high. So when price finally got to this prior peak, momentum indicators would have been overbought. And so yeah, as you can see, it tried to break through this high, failed, creating this rather large bearish engulfing candle in the following week. So if you needed to wait for confirmation, that was your confirmation. Since that was formed, look how fast price has fallen. In fact, even if we look at this example here, you know, we don't need to look at it on the weekly time frame. Let's go down to the daily. This was a key high because prices had fallen sharply from there. Then in the following days, price stabilized here before rallying into this level. I think there was some news from Saudi Arabia that caused this spike. But in any case, from a technical point of view, it didn't hold there. Gaps higher, tried to go above, but closed the day below. So one of the ways you could have traded that straight off the daily chart would have been to place your stop loss above the high of this daily candle, and you could have sold it short on the next day at the open. Price may have gone a little bit against you, but ultimately it would have worked perfectly, and your objective would have been the rounded retest of this high here. Price then bounced at that level before continuing lower.